Stocks see broad-based selling as the rupee weakens but is off the day's low. Declines, however, far outnumber advances. Some rupee sensitives like IT gain, while utilities, energy, industrials and autos slide.
The rupee breaches the 90 mark against the dollar on tight dollar supply and a delay in clinching the US trade deal, while importers and those with overseas leverage brace for impact. Companies with sizable exports like Bajaj Auto cheer the gradual decline.
Me shows 2,400 crore anchor offer draws a rush of investors, but high allotment to a local fund miffs some who walk away. Even as its IPO opens to the public today, the founders promise they'll engage with investors and build new revenue streams to create shareholder wealth.
Asian Paints MD and CEO Amit Singhal expects double-digit growth in the coming quarters with market share gains. Amid increased competition, he also aims for sales of 50,000 crore rupees in 4 years with a promise of strong shareholder returns.
Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Sonal Putra. Well, there are a lot of complaints for the equity markets as well as the rupee and what is taking place both on the macros and the micros at this point in time. We have the mid-cap index which is underperforming. So we have the mid-cap index which is down over 570 odd points and the Nifty which is down around 0.4% as we speak. The key culprit has been the rupee depreciation. It is down for the third day in a row in terms of the rupee. It's depreciated around 70 paise just in the past 2 to 3 trading sessions. And as you can see, currently at around 90.27. So just going from one level to another and reaching the 90 level mark, which, you know, most of the traders actually had spoken about hitting those levels at the end of December.
Yeah.
So that's where we are at when it comes to the rupee depreciation. It's the worst performing currency in the entire Asian space. So it gives you a sense in terms of where we stand, Sonal.
Okay, all right. So that's, of course, the big story that we are tracking very closely. By the way, an IT is one index that you should keep on your radar. It is the only sector or the index in the green today. It is at the day's high as well. So batting it for the bulls. But do remember, it underperformed for a long period. And of course, the rupee depreciation is positive for that index and the companies in that sector. But, broader markets, they continue to be on our radar, continue to underperform. And we have Vivek with us to take us through the stocks that are moving around in trade. Vivek.
Well, that's right. What's essentially transpired is that, market breadth has been quite muted. But in the last 15 minutes or so, a bit of a recovery that we're seeing in the market, and that's aided slight change as far as the breadth is concerned in the broader end of the markets. In terms of individual stocks and sectors that we're tracking, well, can't look beyond the IT pack, clearly a beneficiary of the falling rupee, and that is something that has aided the kind of up move that we've seen today. A Wipro up almost 2.5%, leading the pack as far as the IT space is concerned. From the broader end of the markets, Route Mobile, one of the top gainers as far as the NSE 500 index is concerned, moving up on strong volumes, almost 10% higher over there. Spark yesterday did see some positive news flow coming about in this particular name. Stock yesterday ended at the higher circuit today. Another 8% up move as far as Sun Pharma Advanced is concerned. And DOMS, very strong price action here in terms of volumes too. It's been quite higher. And also, Antique today has initiated coverage on the stock with the buy rating, so 2.5% pop for DOMS. On the other hand, quite a few laggards. Well, can't look past the PSU banks in terms of the laggards today. Yesterday, a clarification coming in saying that at this point of time, the government is not looking to hike the FDI, allowed FBI limit in PSU banks. On the back of that, all of the PSU names today taking quite a bit of a knock. Look at Bank of Baroda, Canara Bank, both of them down over 3%. Along with that, financials, NBFCs too, most of the names today are under quite a bit of pressure. Shriram, PNB Housing Finance, all of them seeing selling pressure emerge. Bharat Forge, the Class 8 truck orders have come by November, both on a month-on-month as well as on a year-on-year, has seen significant decline. And lastly, Angel One, operational metrics that the company gave out today morning is quite muted on the back of that over 4% fall as far as Angel One is concerned.
Okay, all right, Vivek, thanks very much for that. So those are all of the buzzing stocks in today's trading session. But let's now shift focus to the primary market. We do have Corona Remedies 655 crore IPO which opens for subscription on the 8th of December. The price band for the offering is around 1,008 to 1,062 rupees. We have with us Nirav Mehta, who's the promoter and MD and CEO of Corona Remedies, joining in. Nirav, thank you very much for taking the time out. If you could just start by giving us a couple of details with regards to the IPO. We understand that Chris Cap will be selling a certain amount of stake, and it is a pure OFS, so none of the money will be going to the promoter. Or none of the money will rather be going to the company. So just give us a sense, how much is the promoter divesting, how much is Chris Cap divesting, and what are the long-term plans for a PE fund such as Chris Cap in your company?
Yeah, thank you, Ekta. Thank you, Sonal, for inviting me over here on the CNBC live show. We are Corona Remedies Private Limited, going to become a Corona Remedies Limited. Before answering your question, let me take you to the name, because, Corona, we have started on 6 December 2004, where we want to give a name to the company, and we have identified that let's give a name to the company around sun, which is a source of energy. And there's a company nearby that name in the industry, so we have find out other name. A corona is nothing but when sun rises,
sure,
the orange color ring is called corona. Brighter ring of sun, outside sun is corona.
Sure, Mr. Mehta, we get that.
Corona Remedies Limited.
We get that. Mr. Mehta, on paucity of time, I'm going to ask you to just focus on the details in terms of...
Yeah, right. So it is about 10.09% OFS, where promoter family has been divesting about 3.5%, and Chris Capital is divesting about 6.59%. In the company, Chris holds 27.5%. Out of that, they are divesting this. This is about 70% plus OCF EBITDA. So there is, positive cash in the business been generating by the company. So I think so there is no need for the primary as of now. That's why we are going for, 10.09% OFS. Chris Capital has been very seasoned private equity, professional private equity. So they will divest in years to come as far as their stake is concerned.
Got it. The remaining stake, if you can clarify again, it will not be sold in the near term. Have you had that conversation with Chris Capital? Because it's a PE firm which is selling now. Maybe they could sell once, they do get the kind of returns that they have wanted from this particular investment. And in terms of your growth plans, you have been doing a lot of acquisitions to, take up on more growth. So what is the acquisition kitty that you have in place right now?
So as far as acquisition is concerned, we have always gone on the brand acquisition or a therapy basket acquisition, which has been in a fitment to our product. Whatever product has been there in the fitment, we try to acquire if we can able to give the justice to the brand. In the past, we have done the acquisition with a pharma giant, Glaxo, Abbott, and the last acquisition with the Sanofi Aventis, where we acquired a few of their brands. The important is how we can give a justice to the brand. This brand are in the fitment to us, and every time till the time we have demonstrated a great outcome of the acquisition of the brand. We will eyeing on it. Today we don't have anything in the kitty, but we will eyeing on the portfolios or brands which has been in our fitment or in a therapies, or with the therapies we can enter into the new therapies.
Okay.
As far as Chris Capital is concerned, today they are going to divest about 6.59%. We have, they have a full conviction on the company as of now, so they will divest in a years to come whenever they want to divest.
Okay. Well, one of those strategies has been, Mr. Mehta, to, acquire these brands from MNC companies such as Bayer as well as Sanofi and Abbott previously. Myorel in particular, which is a Sanofi brand, how much has it grown? Because it seems to be one of your top brands that you're selling today. So how much was it in terms of sales before you bought it? How much have you scaled it up to? And is that a key strategy of Corona Remedies going forward, which you can apprise us of? Are you going to continue buying MNC brands aggressively?
Yeah, so as far as Myorel is concerned, there's an interesting story. In FY23, we have bought this brand at around 230 crore plus. And at that given of time, the volume of business of Myorel is about 27-28 crore a year. Today, in 2 years of time, this brand has been growing, and we have been eyeing 90 crore plus as far as this financial year is concerned. So we have multifold grown in terms of value. And as far as gross margin is concerned, we can improvise about 800 basis point of the gross margin also. Because we don't have any big brand in the pain management, and Mauril is a perfect fitment to us in the pain management, which has given us a good entry in the market of pain management. We have acquired that brand and given a justice to that brand. Yes, moving forward, we are eyeing on the brands which has been in a fitment to us from the multinational or from the other companies. We are open to acquire brands in our kitty.
Okay. Mr. Mehta, you indicated that 800 basis points gross margin expansion can happen. This is specifically for this particular brand. And are you expecting this similar 3 times growth in revenues that you saw for this one?
So as far as revenue growth is concerned, it's a huge market of pain management. But, you know, in the 2 years of time, we have grown by 3 times. It's not necessarily been necessary that we will grow in the same pace. But yes, we are bullish on taking the market share in the pain management market, and we have make our strategies accordingly. As far as 800 basis point gross margin is concerned, I'm talking only with the Mauril and the group of Mauril, because we have added 2 new SKUs in Mauril Plus and Mauril Max, which was not been launched at that given of time when Sanofi has handled this brand. So put together, we have gone for the increment of 800 basis point of gross margin in group of Mauril from FY23 to FY25.
Okay. Just explain to us, there's been a significant jump in terms of your margins. 15% is what you had recorded around in FY23. That's gone to 21% in FY25 and 21% in the latest quarter as well, thereabout. Is 20 to 21% now a sustainable figure for the company, or are we going to see some kind of, decline in that?
Yeah. So if you look at the pharmaceutical industry, it's a very predictable industry. In particularly, we have about 96.33% contribution out of the India pharma market. And in this market, if we grow on our volume, there are 3 levers of the growth: volume growth, price growth, and new introduction growth. If we continue to grow on the revenue growth, ultimately your employee cost and other SG&A cost has been going down and profitability gone up and PAT grown up. So this is the simplest model which our industry has been witnessing with many other peer group companies also, and we are on the same line. So by adding the people, by adding the geographies, by adding the products, today we have been we are number 1 company as far as volume growth is concerned. We are number 1 company as far as growth is concerned out of top 30 companies. And we are seeing very bright future as far as portfolio is concerned. Reason being, in the pharmaceutical industry, 3 things is very important. Number 1, are you in the right industries? Yes, we are. Number 2, are you in the right therapies? So our therapies are growing little better than the industry. I'm talking about women's healthcare, cardiometabolic, pain management, and urology. Okay. And third, how is your execution philosophy? So our execution philosophy gives us the confidence that in the days to come also we'll try to deliver the good results.
Okay, Mr. Mehta, thank you so much for explaining that business structure to us and the outlook on growth going forward as well. We'll have a conversation again when the IPO opens and when you list as well, so that you can speak freely about future projections as well. It was a pleasure speaking with you. That's the word coming in from this new kid on the block, Corona Remedies. But for now, we'll slip into a short break. When we come back, we'll connect with Jignanshu Gaur, who's the Director and Senior Research Analyst at Bernstein, decode what's ailing trends growth that is on our radar today. Welcome back. You're still tuned into Halftime Report. Let's talk about retail sector. A recent Bernstein report suggests Trend's store network over-densification seems a key reason for sales growth drop. They add that company's revenue growth now is at the bottom. We are now joined by Jignanshu Gaur, who's the Director and Senior Research Analyst at Bernstein. Jignanshu, good afternoon. Thank you so much for joining in. Well, what makes you think that growth is at the bottom for Trend from here on? What are the factors that are indicating that this would be the case?
Thank you so much for having me. It's always a pleasure. We look at 4 reasons why we believe Trend's revenue growth has disappointed over the last 6-7 quarters, and it has fallen from the highs of 50% to close to 16% in the last quarter. And we believe those four factors are sort of at their peak right now. Factor number 1 being the densification of stores. They added a lot of stores, all back-ended towards fourth quarter of last year. Many of them were in the same pin codes where they had existing Zudio stores, and most of them rather, in the same cities where they had Zudio stores. So this impacted existing stores plus reduced the runway for ramp up of new stores, and hence has been a key contributing factor to their revenue growth disappointing, coupled with an element of broader urban consumption slowdown, because we believe most other players who are focused on metro and tier 1 cities have also grown slower than some of the players who are focused on tier 3, tier 4 cities, where the consumption slowdown seems to be relatively better than here. We think both of those large key points are at a peak today. So going forward, the base scenario, the base impact plus the underlying scenario for Trend should be better than what it is today. And hence we pencil in a slight improvement in growth in H2 versus H1. However, we are still under consensus numbers for Trend, but we believe the price indicates even a scenario which is worse than our numbers, which is why we remain constructive on the name broadly.
Jignanshu, if in case you are penciling in the second half growth, can you just tell us what they did in the first half? How much are you expecting in terms of growth in the second half, as well as what the margin performance will be based on what you're expecting, say, when it comes to competition, as well as the densification that you spoke about?
Sure. See, first half growth was approximately 17% YOY for them, 19% and 17 and 16% in quarter 2. We pencil in a full year growth of 19%, which means the second half number should be around 21 odd percent. Festive is a better season for them, so that will help. And then the base effect of last year, where a lot of these stores came into Q3 and Q4, should support the growth as well. So if we pencil in 20-21% growth for H2 of this year. Margin wise, we expect the margin to remain stable. Trend has improved its margins significantly over the last 6 quarters, despite revenue growth rate falling. We believe many of these changes, or rather most of these changes, are structural in nature, led by improvement in employee cost as a percentage of revenue by deployment of technology, as well as other expenses as percentage of revenue. And hence we expect the margin to remain largely stable. We forecast a 14% EBITDA margin for the company for this year, which will be 150 to 200 bips higher than what they did in last year.
Okay,
so better margins, but stable.
Okay, stable margins, but growth bottoming out from these levels. So decent outlook on Trend from here on. Jignanshu, that's about a specific stock, that's Trend. Let's talk about Swiggy as well now. The fundraise, that's a huge one, 10,000 crore rupees. What do you make of it? Do you think the company needs that amount of money for growth purposes? What's your take on this entire exercise?
See, we believe that the quick commerce space is going through significant competitive intensity again. This was the similar scenario in Q2 and Q3 of last year, and the same scenario today. We don't expect 2026 intensity to be lower in any scenario. If you want to be one of the top 2 or 3 players in the market, companies are going to need growth capital. And while food delivery is a net cash flow positive business for Swiggy, as it is for Eternal, we do believe they will need capital to invest, both in terms of capex, but more importantly, in terms of loss funding.
So it'll be for existing verticals for them, or do you think it'll be used for newer verticals? Just trying to understand, because their growth in, say, quick commerce or food delivery has been decent. So do you think it'll be done to accelerate growth there, or look at new avenues?
I would expect a large part of this, at least over the next 12 months, would be for solving the quick commerce business. When I say solving, they need to solve for two things. For the current dark stores, they need to solve for profitability, and they need to bring growth back in terms of their dark store network, which has sort of fallen materially over the last 2 quarters. And that has been a concept, a proper strategy for by them, because they had to balance profitability and cash. So we think it will be largely for quick commerce business. That is what I believe they should be solving for.
Okay. The new labor laws, what is the impact according to you on e-commerce companies?
See, it's still very unclear on what exactly rules the labor laws will take. Even the code which came out mentions a very wide range of 1 to 2% of revenue, and that's like 100% difference. But if we take some broad assumptions, we expect the impact to be 2 to 3 rupees per order, which is material if you assume that they will not be able to diffuse this cost in two big ways. One way is they already spend a lot of money on health, accident, maternity, etc. insurances for their existing gig economy workers, so that they can offset once they start giving this money to a common government controlled fund. Second, whatever is remaining impact can possibly be passed on to either some of the ecosystem players or eventually the customer. Will this impact demand? It might. There is always some demand elasticity, but we don't expect a material derating of the companies in any shape or form because of this.
Okay, all right. Well, we're going to let you go on that note. Thanks very much for joining in and speaking with us about the consumer space. So Bernstein talking about stocks specifically, such as Trent, where they have a target price of around 5,000 odd rupees. They are expecting a pickup in the second half, and they don't see much of an impact on the change in labor laws on e-commerce companies in the long term. We'll take a short break with the news that the markets are weak, so good time to get a technical check. We have Pritesh Mehta of Yes Securities joining in next. Stay tuned. Welcome back. Well, let's get talking about the technicals of the market. Pritesh Mehta joins in to discuss what he's strategizing today. Pritesh, well, it's a dull day. It's a weak day. We've spoken about the rupee weakness already. So how are you approaching today's trading session?
Yeah, good afternoon. Now, see, I believe that this move is more about profit booking rather than change in structure. So far, we have seen 4 days of decline. If you include today's day, we have seen a drop of 400 points from the peak. So I think it does not provide, overall dent in the structures for the index. But we have been following the equal top 10 Nifty index because it commands 50% of the Nifty's weight. And what we have seen that in the month last week, it surpassed the peak of June 2025, and thereafter it has seen a reversal. Similar such reversal is seen even in the customer's breadth. So when both these aspects are moving in one direction, that is on the downside, we can see a bit of cooling off, and this is what we are witnessing right now. So I won't be surprised that Nifty can retrace a bit lower. It can go back to 25,800 also from here on. So I think this is more of profit booking rather than a large term reversal.
Okay, there is some recovery from the lows though, and that is something which will be key to track after that fall that we've seen. Pritesh, any individual names that you have for trade?
Yes, we like auto space. From the space, Ashok Leyland standouts for us. So basically, the stock, in the month of November was one of the best movers, did well. Now, it was followed by a bit of a shallow retracement, but it's quick to recover. What we are witnessing is the anchor column follow through coming in. So buy Ashok for a target of 185. The stop would be around 152. The second stock that we buy is Max Financial. Now see, this particular stock is outperforming our customer insurance index. When we look at the standalone chart, we can see bullish trade breakout coming in after bullish anchor column. So after a bit of consolidation, the stock is moving higher again. It's resuming its uptrend. So buy for a target of 1900. The stop would be around 1570.
Okay, all right. We're going to let you go on that note. Thanks very much. Let's go across to Mangalam now. He joins in with a setup on what he's tracking on the F&O space this afternoon. Mangalam, over to you.
Well, there has been a recovery from the lows on the Nifty. Yes, we're still lower. We're below that 26,000 mark, but closing in around that 25,950 thereabouts. So that recovery has been led by a couple of these private sector banks. So the Nifty Bank, as a result of which, has seen a mild amount of recovery from the lows as well. At one point, the Nifty and the Nifty Bank were seeing cuts of almost 0.5%, and now they've curtailed those losses to about 1/3%. The mid-cap index, however, is still under pressure, and that's reflected in the advanced decline ratio as well. Almost 2,000 stocks in the red for just about 700-800 in the green right now. So the lines are still far and wide apart, with the red one being much above the green one. What's interesting, however, is the Nifty's declines are curtailed by two factors. One, the IT index is doing extremely well. So the IT sector has a fair weight. And the second part is now, some of these private banks like ICICI and Axis Bank are supporting the cause of the Nifty, which is why the losses are cut less than 100 points. That's a positive. However, the one thing I'll be watching out for, which is an impact of the rupee, and as a result of which an inverse correlation with the bond yields, and that could have an impact on the mark-to-market losses of all these PSU banks' bond portfolios, which is why we're seeing a sharp sell-off in names like PNB, Indian Bank, Bank of Baroda, as well as Canara Bank. So how the rupee moves would have an impact on some of these PSU banks as well. So that's something we will be monitoring. The Nifty, after having recovered from the lows, has now gone back above that 20-day moving average. Closing above that would be extremely crucial. So would be the case for the Nifty Bank. And finally, just a couple of options that I'm watching out for. 26,000 call, extremely well written. So these are calls that have a premium for almost 100-120 rupees. So above 26,100 to around 26,120, there is some supply which is expected. But at the lower levels, there is support which has moved higher. So 25,900 put has been fairly well written as well. And that has a premium of almost 100 rupees. So 25,800 to 25,900 is where the support is. A couple of stocks that I'm watching out for which have seen some open interest action. A lot of long positions added on Biocon, so pharmaceutical and IT doing better on account of weakness in rupee. And a lot of short covering in Vodafone Idea, which continues to do well on hopes of some sort of relief coming in from the regulators.
3.5% higher on that one, and what happens with the rupee at 90.29 currently, that remains to be seen. Thank you, Mangla, for joining us with all those F&O trends. It's time for another break now. On the other side, Manisha Gupta will join in with Surendra Mehta. He's the Secretary, India Bullion and Jewelers Association. Stay tuned for that.
Welcome back, and joining us on the show now is Surendra Mehta. He's Secretary, India Bullion and Jewelers Association. Mr. Mehta, hi, thank you so much for joining in. And this is about IPO putting out a self-regulation when it comes to the digital gold companies there. We do understand after SEBI's warning, a lot of these companies had also approached the regulator to, in some sense, start regulating. But that clearly seems to be a bit delayed, the work being done on that or not. But IPO taking this step, how does it augur well for many of these companies?
Well, we have, when the SEBI issued the caution, we requested SEBI to regulate these digital gold companies. See, most of these digital gold companies are very top companies, very big companies, and with a huge net worth available in their balance sheet, and they have nothing to hide. So we requested SEBI to regulate them. But definitely, I think SEBI will not like to regulate it. So in the meantime, all these top companies have approached IPO, and we have voluntarily decided that we will set the rules for the digital companies. Whosoever want to join us, digital companies, whosoever want to join us, they can join us. We will set the entire framework for the digital gold companies regarding purity standards, vaulting, how the payment is to be collected, how taxes are to be paid, how auditing is to be done, whether auditing is required with the industry experienced auditor or not. So there are so many things to it. So we have decided that we will take this further. And initially, we will be calling the consultation meeting for all the digital gold players. But we would be strictly following the rules as decided in the digital gold consultation meeting.
Mr. Mehta, how many companies are there? I'm assuming there are very few service providers and then everybody else partners with them. So how many companies are we looking at in sense of service providers, and what is your sense on what is the number or quantum of these companies meeting the end consumer there?
You rightly said there are many intermediaries who are actually collecting digital gold money on behalf of the primary companies. So according to us, this primary company's number will not exceed even 12 or 13. But we will be regulating not only primary gold, digital gold companies, but also these intermediaries. And many of these intermediaries have also approached us because we want to ensure that this intermediary, whatever payment they collect, it goes to the primary digital gold companies.
Mr. Mehta, also, what is the quantum of the overall market right now? We do understand that the base is low, but the growth has been quite higher. And in the last couple of months, since the SEBI warning, we've seen the number kind of decline. What is it that we're looking at in sense of overall market share for this one?
Well, honestly, the actual numbers are not available, and we are trying to find out what is the actual number now. But honestly, there are many proprietorship and partnership firms also doing the digital gold business, and we do not encourage such practice, and we would definitely keep them out of our regulatory framework. In my opinion, if I take out this partnership and proprietorship firms, and only look at the top companies, I think the overall market size does not exceed 20 tons.
20 tons.
Yes.
Since you are with us, Mr. Mehta, what is also your sense on the kind of gold imports that we've seen in this year, and your sense on prices also?
Well, gold imports, that is really, the numbers are really shocking at the prices at which the gold import is being done. And in my opinion, there is a lot of stocking happening by the jewelers themselves, on the presumption that there would be a very good wedding season and festival season ahead. But in my opinion, I think the government needs to do something, because if the bank's working capital are being used for stocking of the gold, it doesn't, and if the USD INR goes above 90, then it is really a cause of concern.
Okay, all right, Mr. Mehta and Manisha, thank you so much for joining in today and taking us through this conversation. So important to track what happens with gold demand, pricing, and various ways of investing into gold as well. With that, we'll slip into a short break. When we come back, we'll connect with Mahendra Kumar Jaju of Mirae Asset Investment Managers. The rupee has breached that 90 per dollar mark. So what happens next? We'll discuss with him.
Welcome back. Well, the rupee fall does continue. In fact, it's hit a fresh record low in today's trading session. It's crossed that key critical 90-odd mark in terms of the rupee. And as you can see, 90.25, 3 consecutive days of losses or depreciation that we've seen for the rupee. But we do have Mahendra Kumar Jaju, CIO, Fixed Income Mirae Asset Investment Managers, joining in to discuss his take on the rupee. Well, thanks very much, Mahendra, for joining in. We've crossed all of these critical levels that many of the technical and fundamental experts have been discussing will possibly be hit, by the end of the year or maybe going into next year as well. Where do you think the rupee is possibly going to stabilize at? And do you think that there's a further fall in place?
So at this point, the direction is clearly for the rupee to depreciate further. 90, just a number. The momentum is towards depreciation of rupee. At this point, we have a very, very strong domestic macro, but our global macro seems to be a little bit of a concern right now. We have a slowing export, and because of the domestic consumption story, we have swelling imports. So that is affecting our current account deficit, which is expected to comfortably breach 1% mark in the current year. We have very delicate situation on the trade deal front. There is no clarity as of now. While there is hope, but there is no outline of what the deal might be, and it is beginning to affect our competitiveness on the export side. And then we have seen consistent outflow from the FPIs, because in the current year, the markets like Korea or Japan have done well, and therefore the global investors have been allocating to those markets. And finally, we have seen some of the currencies in the, for example, Latin American countries like Brazil and Mexico, they have done 10% plus appreciation on the dollar. So I think as a cumulative impact of all this, rupee is under pressure, and when everyone realizes, I think the momentum obviously takes the movement much faster, and the targets are easily breached. So I think today is one of those days when the entire force is against the rupee.
So do you think, Mahendra, that will continue? What kind of levels are you watching out for, say, in the next 3 to 6 months? And when you said it's allowed to depreciate, you don't see any intervention coming in from the RBI in terms of using, foreign exchange reserves, other methods?
We have a very, very strong forex reserve situation. However, the rupee is weakening in line with the fundamentals, so to say. In the last year, in 2024, the rupee was amongst the best performing currencies in the second half of 2024, but then that took its toll on the domestic economy. So we have seen at the beginning of this year, RBI switching the gear, and RBI instituted a very, very accommodative monetary policy. They cut the policy rate by 100 basis points during this year. They cut the CRR by 125 basis points. They did the open market purchases of bonds of about 2.5 lakh crores, and that then gave the momentum back to the domestic economy. And we are now, seeing this kind of a growth momentum. At the same time, rupee suffered. So I think at this point, the Reserve Bank is more focused on calibrating and moderating the volatility in the rupee movement, but I don't think there is any clear guidance or indication as to whether or not they allow or accept this depreciation. So we will know, but I don't think that there will be any meaningful intervention to change the direction, but obviously to moderate and smoothen the volatility, there will be periodic interventions.
Okay, periodic interventions to smoothen the volatility. Well, thanks very much, Mahendra, for joining in and speaking with us about the rupee depreciation. Around a 4.5% depreciation in the rupee is what we've seen in 2025 already, and over 1% odd in just the past month. We'll take a short break, but get you more on the markets on the other side. Stay tuned.